Hi guys, and good morning. It's G-Economics here, and today I'm going to bring you a video with regard to something new on the A2 specification, which is the market for loanable funds. Not to be confused with the money market and the money market diagram. This is something slightly different, although the two are linked together, as you will see. So this is what we are referring to as the market for loanable funds. So let's get to it. So what is this market for loanable funds? Well, first thing to say is that it is similar to any other market. What is a market, ladies and gentlemen? It is something which brings together buyers and sellers. So in the same way, the market for loanable funds is bringing together, in this instance, savers and investors. And of course, you may already be aware that in order for investment to take place, banks and building societies and so on, they need the liquidity within their deposits in order that they can make the necessary loans. So if firms wish to invest, really we need to ensure that banks have a certain amount of liquidity within the system. As I've said, it's not to be confused with the money market. And you'll be familiar, I'm sure, if you're already up to this stage in the A2 specification, you'll be familiar with the fact that in the money market, the interest rate is seen as the opportunity cost of holding money. So therefore, when the interest rate is high, the demand for money balances is low. You'll be familiar with that diagram, I'm sure, with regard to liquidity preference, whereby we have the interest rate and the quantity of money, and when the interest rate is high, demand for money is low, interest rate is low, demand for money is high. Now that, of course, is related also to the demand for shares and bonds, which you can see in one of my previous videos. So I'm not going to go into that in this instance. So, in the market for loanable funds, what is the interest rate in this instance? Well, for an investor, it's the opportunity cost of the investment. For the saver, it's the opportunity cost of saving. And of course, we're primarily talking here about savings made by households. So if the investment is not made, then the money could be put in the bank and interest earned. And for households, if the money was spent rather than saved, then obviously you're giving up that interest rate return. Okie dokie. Now, you may, I hope, be familiar with this. I hope you can see this on the, I hope it's recording and everything is in view. So we've got this little equation here. Savings leads to investment leads to growth. It's a very familiar phrase, particularly when you start to look at the whole notion of development economics, for example. So savings are required in order that investment can be made, and obviously then investment leads to both short-term and long-term economic growth. Why are savings necessary? Once again, it's to do with this whole notion of the credit creation multiplier and the ability of the banking system to lend for investment purposes, and hopefully that then generates growth within an economy. And it's the interest rate, of course, which is important in bringing these two things together, in bringing them into equilibrium, in fact. In order to bring savings and investment together, it's the interest rate, really, which is the key thing here, ladies and gentlemen. So this is your textbook diagram. I can't remember which, it's in chapter 18 of the OCR Peter Smith textbook. And this is the market for loanable funds diagram. And in very basic sort of terms, and we're going to look at this in a little bit more detail than it gives you in the book, but in quite simple terms, we've got our savings rising as the interest rate rises. Obviously you're more likely to deposit your cash into the bank when the interest rate is higher. And for a firm investing, well, as the interest rate is falling, the quantity of investment is going up. And why is that? Of course, that is because the actual cost, the loanable cost for that, will be that much more manageable, given that the interest rate is less. Not that it will be cheaper, it's simply that the interest rate charges will be less per month or per annum. Okay, so that's quite a simplistic way of looking at this diagram, and I guess one of the key things to say about this is that this is not the same as the money market diagram, which you will of course be familiar with. Those of you who've done the transmission mechanism, even liquidity preference, you'll know that your sort of traditional money market diagram is where we're looking at money supply, money demand, and we have an interest rate determination here as well. Well, this really is the interest rate determination with regard to household spending and demand for money. You'll be familiar with transactions, precautionary, speculative demands for money. This, as I've already said here, this is important for bringing together savings and investment. Now, the other key thing to note here is that really when we're talking about the interest rate, we're talking about the real interest rate. Now, for those of you who don't know, the real interest rate is calculated by the nominal minus the rate of inflation. Now, that is very important to assume that this is the real interest rate, because inflationary effects on both investment decisions, and saving decisions can be very important and could adjust the way in which these curves line up. So that is a very important point to note, and I'm going to come back to this at a later stage. Okay, now so we're going to take this just a little bit further than is in the OCR textbook. I think it's worth doing. So when I'm interpreting this diagram, I like to think of these curves in a slightly different way, and I think it's easier to understand if you interpret these curves either as this is the return on savings and this is the return on an investment. And so if we considered this particular equilibrium, ladies and gentlemen, in this diagram, and let's say it's a 10% rate of interest at an output and quantity of Q1, bear in mind that this is the quantity of loanable funds. You might wish to think of this as the demand for loanable funds and this is the supply for loanable funds. That also helps, I think. Now, in this instance, projects, and by projects I mean investment projects, capital investment projects, on this basis, if the equilibrium interest rate was 10%, then projects with a rate of return greater than 10% would be funded. So all these projects here, all these investment projects here, which in theory are going to yield a return greater than 10%, as they lie above the 10% yield, they will be funded because the return on the savings is less. So you might as well, therefore, if you're a bank or an institution, it's in your interest to make these funds, make these loanable funds, to use the term, make these available for investment projects. Whereas when you get beyond this point, past Q1, these projects would not be funded. So the reason being, of course, that the return on the savings now becomes greater than the return on the loanable funds. In other words, the return on the investment. And so it would be slightly irrational in that sense. If it was the investment was being purely made on this sort of differential here, then that would not be a sensible way to proceed. So in order to sort of think of it as the demand for loanable funds and the supply of loanable funds, I think that helps us to understand this diagram. So as I've said, the market for loanable funds is a market just like any other. And so we can manipulate the demand and supply curves on a diagram such as this. So for example, in this particular instance here, you can see that I have shifted the demand for loanable funds, so it's gone from I1 to I2, and so the equilibrium has moved from Q1 effectively up to Q2. And because of that, more projects would be funded. Initially, we would have, obviously, up to the initial equilibrium of projects being funded, but after the shift in the demand for loanable funds, then more projects would gain funding, as I've just said. And of course, that is because more projects therefore become profitable. Now, what would cause the demand for loanable funds to shift to the right? Well, the economic cycle, for example. In a recession, the demand for loanable funds will be shifting probably in this direction because firms do not have the confidence to invest, they do not have the desire to invest. It could be to do with inflationary expectations, and so the demand for loanable funds would be moving in this direction. However, when the economy is in recovery and moving towards boom and so on, when the demand for loanable funds grows, that would shift the curve to the right from I1 to I2, and you would therefore see that more projects would be funded. Another thing which would shift it to the right would be if the government is running a budget deficit. Well, in order to finance that deficit, excuse me, as you know, the government will be issuing bonds, government bonds in order to finance their borrowing, and as a consequence of government deficit financing, the demand for loanable funds will also shift to the right, and again that would cause more projects to be funded. And of course that stands to reason, because when the government is operating a budget deficit, it's an expansionary fiscal policy, and therefore one would expect that new projects are undertaken, and so that causes the economy to expand. What about the supply of loanable funds, ladies and gentlemen? So this savings function as referred to in your Peter Smith textbook. So remember that this is the savings really. Now if households, for example, decided, well, we are going to save more and consume less, so that could be to do with uncertainty in the economy, then we'd be moving to the left. And so rather than having Q10 fund projects being funded, it would be a reduction in the number of projects being funded, and obviously vice versa. If we had lots of capital inflows into the economy, so from foreign economies injecting funds into our financial system for one reason or another, then that would shift the curve to the right. So there are a combination of factors which would shift these things to the left and right, and again they either make the prospect of more investment projects more likely or less likely, depending on what way, depending on the direction of travel. Okay, so now I would just like to say a little bit about the real interest rate, which I referred to at the beginning, with regard to whether or not projects are undertaken, because of course the interest rate, but more specifically the inflation rate, has a very big impact on savings and investment projects. So I just wanted to give you a little example as to why that. So I mentioned, ladies and gentlemen, at the beginning of this video, the real interest rate and how we calculate the real interest rate. The real interest rate equal to the nominal interest rate minus inflation. And why is that important? It's important because inflation particularly has a very significant impact on savings and investment projects by firms. And so I just want to give you a little example as to why the real interest rate is very important for a bank making a loan. So for example, let's say the bank issues a loan at a rate of 10%. So I'm just looking at sort of over a 1 year period here. So at the beginning of the year, £10,000 is issued. Inflation over that year is 0%, and at the end of the year, obviously a 10% interest rate charge would mean that you repay the initial 10,000 plus an additional 1,000, which gives you the 11,000. If you were to then calculate the real interest rate is obviously equal to 10%, which is our nominal rate, minus the inflation rate of 0%, which is equal to 10%. So that means that in real terms, when the bank receives that £11,000 back at the end of the year, it is actually worth more than the £10,000 that they issued at the beginning of the year. Now, from the lender's point of view, that is a good thing, because obviously that would buy them a larger basket of goods than the 10,000 did when they issued the loan at the beginning of the period. However, what if inflation over the period was 10%? So still 10,000 being issued, but this time the inflation rate is 10%. So the real interest rate is 10% minus 10%, which is equal to 0%. Now, that means from the lender's point of view, they have actually issued a loan to the lender, to the borrower rather, at 0%. Now, if you're a borrower, obviously that's tremendous, because in effect you're not actually paying in real terms, you're not in fact paying any more money back. So that in effect is a 0% loan. But what does it mean from the bank's point of view? Well, it means that the £11,000 at the end of year one buys the same basket of goods as it did at the beginning of the year. So from the lender's point of view, that is not a favourable loan to be issuing. And so this is why it's very important that when loans, and this whole notion of market for loanable funds, when loans are being issued, it's very important that banks and so on, financial institutions, do take into consideration what the inflation rate is and price these expectations into their loans. And of course that is what happens. And so if financial institutions did anticipate that inflation would be much higher in the future, these expectations would be priced into their decisions. And so rather than the supply of loanable funds, demand for loanable funds lying here, the whole equilibrium in effect would be ratcheted upwards in order to take account of the fact that inflation may be higher in the next year, for example. And so therefore if you charge a higher interest rate minus what you anticipate to be a higher inflation rate, you're still going to get some type of return on it. So from the lender's point of view, that is a very important aspect of the decision-making process. And so economic agents price these expectations into either their savings or investment decisions, moving this equilibrium upwards. So it's a really important point, that, with regard to real interest rate expectations. It sort of links in nicely with the whole notion of expectations theory, which we've looked at in the past with regard to Friedman. Okay, so I said at the beginning of this video that the market for loanable funds is not the same as liquidity preference. And so in this diagram I just want to explain to you and demonstrate to you why they're not the same. However, the interest rate in both markets will probably end up being the same. So if we start here on the left, you'll be familiar with this. This is our liquidity preference diagram. Money supply, money demand. Now, our initial equilibrium is MS1 at R1. If the central bank increases the money supply, as you know, the interest rate falls. Now, via the transmission mechanism, remember, transmission mechanism is a change in the money market leading to a change in the real economy. So that's your macro diagram feeding into inflation, unemployment, growth, etc. So via the transmission mechanism, this reduction in the interest rate would lead to an increase in aggregate demand, which would increase real output. So your traditional sort of KAS diagram where AD is shifting to the right. Now, what would be happening in the loanable funds market? Well, as aggregate demand rises and shifts from AD1 to AD2 via the multiplier process, and potentially the accelerator, households would find that they have more income, and as a consequence of that they would be able to save more. And so the supply of loanable funds, or the amount of savings in the economy, would also shift from S1 to S2. And you can see that as a consequence of that, the interest rate in both markets, market for loanable funds and money demand, money supply, the interest rate has dropped to the same level in both. Because some of that additional income is spent, because some of that additional income is saved. Hence we go S1 to S2. Now the interesting point here is what is the cause and what is the effect. So in the short run, the loanable funds market is following the money market. As the interest rate in the money market falls and sets off the transmission mechanism, then it's following that, and ultimately it ends up with the interest rate in both markets being the same. Now what would happen in the long run, in the longer term? Well, in the long run, you'll, I'm sure, be familiar with this anyway. In the long run, As AD shifts to the right and the economy is growing, so too does the demand for money. So the demand for money would shift back to here, shift upwards to here rather, to MD2. What happens? The interest rate rises. What would happen as a consequence of the interest rate rising? Well, aggregate demand would fall because, as you know, interest rate rising, so that's a tightening of monetary policy. Interest rate sensitive components of aggregate demand start to fall, and so AD would start to shift back in this direction. As AD shifts back left again, households' ability to save is diminished, and consequently the savings function would move back in this direction, or the supply of loanable funds would move back in this direction. So it's very interesting the way in which one market follows the other. It sort of ties those two things nicely together. As I said, this is quite a brief section in your textbook. I've gone over and above what's in the textbook, but I think it's just worth doing just for this additional info. Anyway, I hope you've learned something there. Do subscribe, and look forward to bringing you the next video very soon.